All right, we got some great news for CoreWeave stock investors as the company's management team elaborated on the huge increases in revenue, orders, backlog, and the potential for this company to continue increasing revenue significantly. I wanted to share those details with you in this relatively short video. Let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So CoreWeave reported second quarter revenue came in at 1.2 billion, increasing 207% year over year. I'm following close to 300 companies, and very few of them increased revenue by 207% year over year, and fewer still at this size. It's easier to grow revenue by 207% when you're generating a few hundred thousand in revenue or even a few million in revenue. Very difficult to generate this kind of revenue growth when you're generating revenue in the hundreds of millions and now in the billions of dollars, as CoreWeave just did. Furthermore, their revenue backlog is expected to scale rapidly over time. It was already at 30 billion, which was up 86% year over year, and the management team saying that it's expected to grow rapidly over time. Man, that's great news for CoreWeave stock investors. They continue to ramp their investment in data center and server infrastructure to meet growing customer demand. And that's reasonable to do, right? When you're a manager of a company that's experiencing this kind of growth and this kind of increase in demand, it's reasonable to invest to meet that growth so that you can generate that revenue. Otherwise, if you're not ready for those customers are going to look elsewhere. So you lose twice. You lose out on the sale. You also lose because that sale goes to one of your competitors, making them stronger. And so that's why it's reasonable for management to invest in the company's infrastructure so that it has the capability to meet this increase in demand. So already in the second quarter, they spent $2.9 billion, which was up over 1 billion from the previous quarter as they scale rapidly to meet their accelerating customer demand. So not only is customer demand increasing, but it's accelerating, meaning that it's growing at an increasing rate. The year-over-year growth continues increasing, and that's great news for CoreWeave. Management said that they're going to significantly increase their capital expenditure, which is going to these data centers to serve that demand. And more of that will be spent towards the end of this year. The manager said that with the strong demand backdrop, we expect third quarter revenue in a 1.26 billion to 1.3 billion range. In addition, we anticipate Q3 adjusted operating income at about 175 million at the midpoint. So the company's revenue is soaring and they're profitable on an adjusted operating income basis, but they keep investing for growth. They're investing significantly for growth. So they're not even focused on profitability. They just happen to be profitable because they have so much in sales and sales are booming so significantly that they're generating profitability. But as they ramp up these investments, I wouldn't be surprised if there is some fluctuation in profitability, especially starting Q1 and Q2 next year in fiscal year 2026, because that's going to include those massive investments in capital expenditure, which are going to flow through to depreciation expenses on the income statement, and that's going to decrease profitability on a non-adjusted basis. If you just look at their GAAP operating income, the depreciation expenses likely to soar starting next year. So they expect capital expenditures to increase again in the third quarter to around $3.2 billion. And then in the fourth quarter, they expect it to really increase because for the full year, they're planning to spend over $20 billion in capital expenditure. So far, the year has gone so well that they're increasing their revenue outlook. They now expect revenue of about 5.25 billion at the midpoint. That was up from 5 billion from their previous expectation for 2025. So a 250 million increase in their revenue outlook for 2025 is mostly because of their ability to ramp up infrastructure to meet their soaring demand. This company is now dependent on how quickly can they build the capacity because customer demand is waiting for it to just build and serve that demand. And by the way, this earnings call transcript, this is Q2 2025 for CoreWeave. I've made this highlighted document available for my channel members. You see the link in the description for all the benefits you get for joining our channel. It's less than $5 a month. We would love to have you join us. As I mentioned, they expect capital expenditures between $20 and $23 billion, unchanged from their previous outlook. And they say the significant portion of their full year capex will fall to Q4 because of the timing of the go live dates for their infrastructure. Or, whenever they're completed and ready to be implemented, that's when they're going to recognize the majority of their capital expenditure for their company. And that's when, starting in Q1 of 2026, they can start to use those facilities that are getting put up in the fourth quarter or being completed in the fourth quarter. Maybe even during the fourth quarter, they can start, selling those capacities that come online during Q4. And then you'll really start to see the impacts starting Q1 of 2026, where I wouldn't be surprised if there's another significant increase in revenue for the company in 2026 and probably again in 2027, as there's just insatiable demand for artificial intelligence. Companies like OpenAI with ChatGPT are seeing hundreds of millions of weekly active users, and that amount is growing by the millions every week. Customer usage is increasing, business usage of artificial intelligence is increasing, government usage of artificial intelligence is increasing, military usage of artificial intelligence is increasing. Every category is increasing their spending on artificial intelligence, whether you're an actual AI company like OpenAI, or even if you're a company like McDonald's. They're incorporating AI into their services, into their drive-through locations, into their ordering services, everywhere. Every company seemingly is trying to adopt artificial intelligence because of the potential. And that potential has only increased because the cost of wages have increased so meaningfully. And here in the United States, especially here in California, and then even more especially in Los Angeles, they keep passing new legislation forcing businesses to pay higher minimum wages. And that just makes the investment in technology all that much more attractive because the savings are so much more than if the minimum wages were lower. In fact, I go through a whole discussion about this in my introductory economics class, how governments try in their attempts to help people by increasing the minimum wage. But when they increase the minimum wage, they just push companies like McDonald's to invest more in the technology that replaces workers. Things like the kiosks now that you see so commonly across McDonald's restaurants are replacing cashiers, because in California they're forcing restaurants to pay higher minimum wages, and I've seen an acceleration in investment in those kiosks. It's a difficult situation, and I often find a conflicted classroom when I bring this discussion up. Some of them, uh, all of them, are in favor of giving people more wages, but also at the same time, they understand that it leads to job losses when you force businesses to increase wages. So artificial intelligence now is benefiting from that increase in wages. Some of it because of, regulation forcing businesses to pay higher minimum wages, and then some of it just because of the supply demand dynamics in the marketplace for certain individuals, creating an increase in wages, which then makes businesses look to artificial intelligence as a way to save on cost, improve productivity, and create more with the same amount of people, or create the same amount of value with fewer people. And so the investments in AI, I don't think will end this year, probably not next year, probably not even the year after that. I think we're set for several years of growth in artificial intelligence because of the real world benefits it adds to corporations and individuals. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.